All right, so today, a few things. One, we're going to cover lecture note 2, which is in the file section of Canvas. So you'll find that in Canvas, which is going to talk about EIC. Today, also, your teams are being assigned, and I was actually in the process of doing it because the auto assignment is not working the way I want it to. So this semester, you're going to be in randomly assigned teams. So you're not going to choose your own teams. I'm literally creating the teams. And so hopefully by the end of today, the teams would have been fully created. Okay? Because the teams I created earlier didn't work because they weren't within the section. You have to be in a team within this section. So given your randomly assigned 6 peers, there'll probably be 7 people on each of the teams. Today you can also start signing up for Stocktrek. So in the syllabus, there was a link to sign up for Stocktrek. Go back to the syllabus. And it's very important that one of your team members sign up using this link, because that link associates you with this class. And then one of your team members will pay the $31.95 when they sign up, either through debit card or through credit card. Now, you're not paying that per member. It's one pays for the whole team. And that will create your Stocktrek account by which your team will start the Stocktrek simulation. And then using that account, you will get 1 grade as a team throughout the semester. And so the way it'll work is that if you go to stocktrek.com, once you sign up, and then you log in, across the top I have my username and password, and it'll associate you, like I said, with this class. That's why it's very important to use the link that is in the syllabus so that it shows you that you're in this class. Across the top, you can see your portfolio if you have one, and as of today, you can start trading. So in terms of trading, Stocktrek will allow you to pretty much trade almost everything, but I have disabled the majority of those options. So the only thing that you can do is you can trade stocks and you can trade mutual funds. That's it. Everything else has been disabled, all right, because this is an equity class. Second, Stocktrek allows day trading. I disabled that. So anything you buy today, you can't sell until tomorrow or the next business day. Anything you short today, you can't cover until the next business day. Can't do it within a day. Because again, just nature of our class. Now you can buy mutual funds and ETFs. You can also buy individual stocks, but no penny stocks. So minimum price, $3 to buy or to short. So if you buy it and it goes below $3, you can sell it, but you can't buy like a 25-cent stock. Okay? So again, minimum asset price, $3. And with $1 million, you can buy a margin up to $2 million worth of potential buying power, but you can't put more than 20% of your original cash into any one stock. So you're limited to $200,000 in any one stock. So your goal is between now and I think the 3rd week of October to basically create as much value with this portfolio as you can. You must make a minimum of 10 trades. If you don't make at least 10 trades, your team will be disqualified. You'll get a 0 for the assignment. So you must make a minimum of 10 trades over the next 45 days or so. At that day, every night, you'll see here under my portfolio, there's a ranking. So as teams sign up, and you'll see who's associated with this class, then you'll compare yourselves against your peers in this section that you're registered for. So on that day in October, and then again at the end of December, we'll basically just do the ranking, and then whoever's in first place gets the best score. Whoever's in last place gets the worst score. It's just going to be competitively graded. Okay, so that's kind of the way that Stocktrek works. Okay, general questions about any of that? All right, so to buy, it's real easy. You can come into trading. Say I want to buy a stock. So again, you can buy all different types of companies. And again, you can also go outside the U.S. if you want to. You don't have to just buy U.S. companies. But let's just say that I think, and I'll just make an assumption, energy prices have bottomed out. Energy prices are going to rise. So we've been looking at oil company data. So there's some people that think we're in a trading range. I'll be contrary to that. I'm going to bet on oil prices rising. And I think that a company like, I don't know, who am I going to pick? I'm going to pick Exxon Mobil, XOM, will do better. So I will buy Exxon Mobil. I can decide how many shares I want to buy. So I'm going to buy 10,000 shares of Exxon Mobil. Market price, I can also do a limit price. And what it'll tell me that 10,000 shares is $874,000. And the most I can put into any one position is 250,000. So I can't buy 10,000 shares. But I can buy 2,500 shares. Okay, so I'll buy 2,500 shares of ExxonMobil. Market price, limit order or non-limit order today. Market price order, come down here. It's going to cost me $218,000. Preview. Am I okay with that? Confirm. And I just bought 2,500 shares of ExxonMobil. Okay, so this is the third section of the day for me. So in the previous two sections, I can go and look at my portfolio. I now own 3 stocks. I bought Lockheed Martin in the first section. I bought Google, which is now called Alphabet, in the last section. I bought ExxonMobil in this section. I'm just playing for fun. But nonetheless, these would be 3 of my 10 trades. Okay, and you can see that already today, made money on Lockheed, made money on Google. I quickly am losing money on Exxon. Okay, so, and again, if I want to get out of a position, I can sell, I can buy. But as I said, what matters more is where I end up in October, not where I end up in today. And so in order to do well in Stocktrek, you're going to have to pay attention to what's happening in the real world. And it's basically going to be looking for news and information about these companies that's going to be driving the stock prices. So that's one of the things that will be very important. Questions about Stocktrek? You must establish trading rules as a group. So you have to be careful because in previous semesters we've had what I guess I would call the rogue trader effect. So on what happened, I think, last semester is one of the team members decided to go trading without telling any of the other team members. They did like 50 trades. They lost like 20% of the portfolio value. All the trades went awry. And the team was so far out of it that they finished in last place for the semester, and there was nothing they could do about it. And unfortunately, I can't stop that from happening. So it'll be very important for you, because this is your group grade, to determine as a group who has access to the account, who's going to be buying, who's going to be trading, what can be bought, when. And that is going to be very important for each of the groups to set up as a rule so you don't have a rogue trader. Right? Now, when you do sign up for your account, as I said, the person that signs up will be creating the username and password, and that'll be the one that the group will share. So again, you can control who has access rights to that. When you create a team name, you can create any fun name that you want. Just make sure it's not too much fun because it has to be something that can be stated in a public forum. But other than that, you can have a little fun with naming yourselves whatever you want. So again, we'll figure out which companies you're going to be trading against in this section. Stocktrek. Have fun with it. It's an interesting simulation. And again, we'll leverage the concepts we're going to be covering this semester. So today, as I said, we're going to be talking about EIC. So a couple of upcoming logistics. On Wednesday, Bloomberg is coming. They're going to send 4 people. And they're going to spend the entire day here at the University of Maryland. And they're going to be teaching all 4 sections. And they're going to teach you advanced use of the terminal. So they know that you've all been certified. I spoke with them this morning. I told them what I want them to teach you. And so they're going to teach you how to do custom fields. They're going to teach you how to do custom screening. They're going to teach you how to export data and use it in Excel. They're going to teach you how to do custom reports and to do quick comparisons against peers relative to valuation. So they're going to pick up on where you did the certification, and they're going to go a lot further. Very important because homework 4 will come out of the training that Bloomberg is giving you. So I gave them a preview of what you're going to have to do for homework 4 using the terminal. So basically, it'll be very important for you to pay attention when they're here to make sure that you know how to do homework 4. So they're not going to do the actual homework, but they're going to teach you the tools to be able to do homework 4, as well as some other things this semester. Now, it's also very important to understand that the people that are coming from Bloomberg are also here to recruit. They are the first line of recruiting for Bloomberg on colleges. And they asked me, they said, do you mind if we recruit? And I said, absolutely not. I'd love for you to recruit. And the students would very much appreciate that, because we've actually had Gilly, who's one of the TAs, was a Bloomberg intern because she went through the recruiting process and got an internship this summer. She's now the TA. As a matter of fact, my TA last semester, and coincidentally I made them TAs, but also was a Bloomberg intern. So they're going to be looking for juniors that want internships, and they're going to be looking for graduating seniors that want full-time jobs. And I'm just telling you, the people that are coming are really good to network with, because they are screening for people to bring to New York for candidates. I think they're also possibly having a reception here on Wednesday night. But take advantage of that with the people that are in the room. So again, it's another great opportunity for you guys this semester. So very important to set up for what we're going to do in terms of the equity valuation and use of the terminal on Wednesday. So with that in mind, let's talk about EIC. So again, I put up lecture note 2 in the file section. Let me go to lecture note 2, which stands for EIC. EIC stands for E is economy, I is industry, C is company. General premise is this: about half the performance of any company is going to be the industry that it's in. So therefore, we need to understand the economy. How will the economy affect the company? So for example, think about Exxon. Oil prices are going to be very much dependent on what happens in the economy, and therefore what happens to ExxonMobil and all the other oil companies is going to be based on what's happening with oil prices. So, or the industry. Some industries are more attractive than others, and we're going to talk about that in class today. So we need to understand the industry dynamics that make some businesses more attractive. And then we're going to look at competitive advantage and whether companies can outperform the peers. So that's the idea of the EIC framework. But it's really an external framework. If you think about Warren Buffett, who's been one of the more successful investors historically, he actually starts with industries. Warren Buffett doesn't invest in companies, he invests in industries first. Once he finds a good industry, then he finds a company that will succeed in that industry. Because if you're in a lousy industry, there's nothing you can do. Right? And so that's the perspective that we have to have when we analyze companies. So let's start out with the economy. I think when you guys, I've logged into a Bloomberg terminal, so I think when you did your economic certification, one of the screens that you saw was the Economic Surprise Index, ECSU, right? And so one of the things Bloomberg did is it took 41 leading economic indicators and it put them on this screen. And remember, we're focusing in this class on intrinsic value, which means a company's worth the sum of its future cash flows, not the historical cash flows. Therefore, expectations are really critical. So just as there are analysts that are forecasting cash flows for companies, there are economists forecasting economic information for the markets. And so these are 41 different economic indicators and the forecasts of the economists of each of these indicators. And then when they're released, the actual data, it's data against what was expected, and so therefore that creates positive and negative surprises. So the graph over to the right shows you the orange line is the performance of the S&P 500. The red is when these indicators had negative surprises. The green was positive surprises. But here's the general idea. When the economy is performing better, stocks generally perform better. When the economy is performing worse, stocks generally perform worse. So when the expectations are getting worse than expected, then you would expect stock prices to go down. When the expectations are getting better than expected, you would expect stock prices to go up. That's the idea of the Economic Surprise Index. So what they've done is they've grouped these indicators into these 6 categories. So you have the housing and real estate markets, you have the industrial, you have labor, your personal household, you have retail, and you have the business surveys like the leading economic indicator index as well as consumer confidence indexes. And you can see that recently 4 of these markets have had negative sentiment. However, you can see this data right here that on last week, Friday, jobless claims came in better than expected at 259,000. Continuing claims for, again, jobless workers came in better than expected. You can also see September 8th, consumer credit came in better than expected. Wholesale inventories, September 9th, came in better than expected. Non-manufacturing index came in a little worse than expected earlier last week, but you go down here, consumer confidence for August came in better than expected. So at the end of last week, there was a newspaper story in the Wall Street Journal that basically said Federal Reserve member quoted as saying they might actually raise interest rates, right? And you can almost see it in these indicators. These indicators are coming in a little bit better than expected. Economy a little bit stronger than expected. Okay, maybe this gives the Fed cover to actually raise some rates. Well, that caused a bunch of Asian markets to tumble over the weekend, right? Why? Why would higher interest rates hurt equities? Yeah.
Because maybe they can invest less in the U.S. economy if the interest rates are higher.
Okay, so that's one reason. What else? Go ahead.
The stronger dollar, you're not going to be exporting.
All right, so it's going to affect currencies as well. So we're going to think about what the impact of the dollar is going to be. Yeah.
Less money will be invested in equities and more in fixed income.
And so it makes fixed income relatively more attractive than equities. But here's something even more fundamental. Capital asset pricing model, known as CAPM, right? What is the actual definition of CAPM? What's the formula? Everybody remember? Yeah.
I think it's like risk-free rate.
You start with the risk-free.
Beta times like the market risk premium.
So you add the market risk premium, you don't subtract it. So it's the risk-free plus the market risk premium times the beta. So here's the point. When the risk-free rate goes up because the government is increasing interest rates, then the cost of capital, when you run it through the CAPM, gets higher. And if companies' cash flows don't change, then all things being equal, equity cash flows are worth less. So if you really want to think about it, the exercise that we saw Friday and then earlier today in Asia was an exercise in CAPM. So it is the reasons that you mentioned, but it's also the idea that when interest rates rise, cash flows are discounted at a higher rate, those cash flows are worth less, pressure on equity markets, right? And so that's why the market right now is going to be very sensitive to changes in interest rates. And this is what I mean by we got to be paying attention to what's happening with the economy and what's happening with the economies and whether or not governments around the world are going to be starting to finally raise interest rates, because that's going to affect stocks, right? Because it's going to affect the discounts on the cost of the capital. So this is what I mean by the E in the EIC, right? So back to this. One of the tools that you have in front of you is very powerful because it's giving you access to this data in near real time as new economic information is coming out. And so the next question is, okay, what can we do with this when it comes to equities? Are there more companies that are going to be sensitive to changes in these marketplaces, right? That's where the economy comes in. So here's one of the simplified ways that we're going to think about this is we're going to say that when we do economic analysis, one of the things that's going to drive sensitivity is something called beta. Okay, and you talked about it in CAPM. So RF plus the risk premium, RM minus RF times beta. Beta is the sensitivity of an individual asset against that market basket. So here's the transitive property we're simplistically using this semester, right? So here's the point. What Bloomberg is showing us in the surprise index is that the economy gets better or worse, the stock market gets better or worse. So the question is, how does a company correlate to the stock market? So here's the point. What if a company's beta is 1? What does that mean? Yeah. Pretty much, yeah, they're going directly up or down the same amount as the economy. So therefore, if I want to basically just look at a company and their beta is 1, then I know that they're going to be sensitive to changes in the economy. What would a low beta stock be? What would that tell me? Yeah.
There's like a negative one?
Just call it low beta, 0.6, something like that.
Correlation's not going to be correct.
They're not going to go up as much. They're not going to go down as much. Yeah, which means a low beta stock is going to be less sensitive to changes in the economy, and I probably don't have to worry about it as much. Versus a high beta stock is going to go up much faster than the economy, going to go down much faster than the economy. So let's put it this way. So let's pick a company. Randomly, I talked about in one of the earlier sections Lockheed Martin. Lockheed Martin is one of the biggest defense and aerospace stocks in the world. If you don't know what a company does, DES. But basically, they make the F-135 or F-35. They make the C-130. They make planes. They bought Sikorsky helicopters. They make the Black Hawk. They make cyber stuff for the government. They actually protect the NSA and the CIA. They do a lot of things. But the point is, big government contractor with gigantic backlog and long-term government contracts. So I know that about the company because they're one of my clients, but more importantly, I wanted to understand their beta. So I type in beta. So Lockheed Martin's beta is, right now, 0.682. That's their raw beta. So this is the S&P 500 index. This is Lockheed Martin stock price. These are the data points. This is the trend line, slope of the trend line, 0.682. That's the raw beta for 2 years, which is the Bloomberg standard. So here's the point. Times are uncertain. I just said that. So why do you think I bought Lockheed Martin in my portfolio for Stocktrek? Yeah.
If you think the equity market isn't going to do as well, then they're not as susceptible to that down.
Exactly right. That's exactly why I put Lockheed Martin into my portfolio in the 11 a.m. section today. So I wasn't really thinking about their financial performance. I was just thinking about we're about to go through a time of uncertainty with economic information. And so one way that I might be able to win Stocktrek is I'll take a low volatility play for a consistent performer. Maybe that's more valuable in the short term. Not saying that's your winning strategy, but that could be a rationale for why I might want a low beta stock in my portfolio. And they've been a consistent performer over time, and they probably will be regardless of the election. By the way, politics and the military are also going to come up because if you watch the news cycle, you saw Hillary Clinton, who looked like a rag doll, being thrown into a van yesterday, and everybody's freaked out about that. And I'm just telling you, that's just going to add uncertainty to this increasingly crazy election over the next few weeks. So it doesn't matter who your political party affiliation is, it just added uncertainty to the marketplace. So that's the point. You're probably going to see more volatility when we have more uncertainty about some things. So in this case, I want a company that will do well in that volatile situation because Lockheed Martin's probably not going to bounce around as much. That doesn't mean that in a volatile market, I can't take advantage of that. And that could be the high volatile, high beta stocks because those are the ones that are really going to move. And if I bet right, I can actually win. Okay, so here was another company that I bought, but let me talk about raw and adjusted beta first. So another way to see beta is if you go to the RV screen, which is the section of Bloomberg that quickly allows you to compare against your peers, and you go to the Markets tab, there's actually a tab called Beta. So not only am I getting Lockheed Martin's beta, but I'm also getting the beta for all of their competitors. And something I strongly encourage you to do is to go to Settings, Global Settings in Bloomberg, check the box for Market Cap Weighted Average. That way, anytime you pull up a screen, Market Cap Weighted Average will be on there. So what it will do is it'll give you the industry average. And it's weighted by size of company, so that way a small company won't completely distort the average. So that's how the Market Cap Weighted Average, that checkbox, shows up on this screen. Everybody see that? So this, for defense and aerospace stocks, is the industry beta, 0.95. This is Lockheed Martin's beta, 0.69. So even within the defense and aerospace industry, Lockheed Martin has a lower beta than many of its peers. Much more predictable company. Okay? Now, here's the difference. Bloomberg also calculates what they call an adjusted beta. An adjusted beta comes from statistics where the statisticians believe in regression to the mean. So the adjusted beta includes a regression coefficient. The way Bloomberg does it is they take 2/3 of the raw and 1, and then they take an average. So they're just moving the raw beta 1/3 closer to the mean. Okay? And that's what they actually use in CAPM. In this class, we're not going to get into a religious debate about adjusted versus raw. We're, for purposes of EIC, though, going to use the raw. Because the raw tells me how sensitive a company really is against the S&P 500, the actual slope of the line. And so when I think about economic sensitivity, I'm going to be thinking raw in this class. So I'm going to refer more to the raw. And here's the point. This is what I know about Lockheed. This is what I know about their industry. Questions? And so this is what I want you to be thinking about. This is the transitive property. So a company's beta is a proxy for how much they move relative to the S&P 500, and therefore is a proxy for the economic sensitivity for that company. So what I'm going to say is Lockheed Martin is less sensitive than the average company to changes in the economy. All right? How do you think it might be different for ExxonMobil? Yeah.
Exxon may have a lower beta because you always need oil since oil is a commodity, and a lot of our economies run off of things that require all sorts of petroleum products.
Okay.
So it's more sensitive to things like movement in supply or demand, and less so to like unemployment numbers and things like that.
Okay. Although interestingly, their actual beta right now is 0.92. So it's not too low because on the one hand, it's something we need, but unfortunately, it is a commodity tied to price, and prices have been bouncing around. Go ahead.
I was going to say, because the price of oil changed a lot, and the economy changed with the price of oil.
Yeah. And particularly supply and demand, is that what we really had is we had too much supply for the last year or so, and with that glut of supply relative to demand, when the economy got tough and people didn't use as much, prices had to adjust, right? So to be honest with you, why did I just buy ExxonMobil? What bet am I making? Why? If the economies are doing better, and that's a big if, but let's assume I think economies are going to start doing a little bit better, and that supply-demand balance has been worked down a little bit, then that could actually be good for oil companies because it could cause the price of oil to go up, and Exxon will ride the improvement of the economy. So in a way, I'm making a bet. Now, I'm not saying my bet is right, but that's the bet I'm making when I'm betting ExxonMobil at a high level, right? And so this is what I'm saying is that as you start thinking through your Stocktrek portfolio at a high level, I want you to start thinking about your own case for what could happen with a company. Now I'll go another company. I bought Google, which is Alphabet. Google's beta is pretty high. It's at 1.31. So this is the exact opposite of Lockheed Martin. Google, I'm actually making a bet that they're going to move, right? But here's the thing. What drives Google's revenue? It's search and to some degree advertising. So the bet that I'm actually making on Google is that in this time of uncertainty, that they're actually going to benefit from that even more because people are going to be spending even more money on search and even more money on search ads, and it's becoming a much more valuable market, and Google will continue to outperform its peers. Now again, my bet could go horribly awry if the economy starts tanking and people cut back on spending, and Google could get really hurt by this. But nonetheless, that's my rationale for the three companies that I bought in Stocktrek, right? But nonetheless, it goes back to the E in the EIC. So what I want you to start thinking about is, like I said, does the economy matter? If so, how much does it matter for this company in the industry? And if so, what are the directions that the economy could move, and what are the implications for the company? So that's kind of the first level of analysis that we want to do. And the nice thing is we have a tool that allows us to do more than guess. So we have data to support our conclusions. And these are some of the screens you should be using. Questions about any of that? I, industry. What is the attractiveness of an industry? Some industries are more attractive than others. So let's define what industry attractiveness means in this class. Specifically, industry attractiveness is industry spread. It's the difference between the industry ROIC and the industry cost of capital. Remember, ROIC is like a proxy for a one-period IRR. So if you don't have a positive spread, you can't create value. You don't have positive NPV. So attractive industries have attractive spreads. What I care about is the spread today, and I care about the spread tomorrow. All right, but let's just start out with the spread today. Is the industry attractive today? Yes or no? What is the industry spread? We're also going to talk about competitive advantage. And we're going to have a very specific definition of competitive advantage in this class. It's different than any other class that you've probably taken. In 25 years of working with real-world companies, no matter how poorly performing a company is, I've never found a company that doesn't feel that they don't have some competitive advantage. Everybody's good at something, right? That's not the definition we are going to use, right? We're going to use a much more harsh definition. By definition, half of the people in this room are below average. I know it sucks to be called below average. I know it's politically incorrect to call you below average, but by definition, half of you are below average. And that's the way we're going to look at the marketplace, because the marketplace is very Darwinian, right? And that's the point. One of the reasons you're in this room is you guys are all above average students, right? So you're an above average cohort, but there are some of you that are smarter than others, right? And so that's the point. Same is true in the real world. That there are some industries which make money because it's a really good industry to be in. But that doesn't mean you're a great company. It just means you're in the right place at the right time. So what I really want is I want the great companies in the great industries. So demonstrate that you do better than your peers with the same resources. Our narrow definition of competitive advantage that we're using in this class is company spread against industry spread. So to do well as an industry, you got to have a positive spread. To do well as a company, your spread has to be better than the industry spread. That's demonstrating financial competitive advantage. Does that make sense? Even if the industry is destroying value, you can still have competitive advantage because you don't destroy as much value as your peers. So let's look at some of these industries. So what I'll do is I'll go back to, again, ExxonMobil. RV, quickly compare its peers. And custom, this is what you're going to learn how to do at Bloomberg on Wednesday. Type in any column in the database for their 870,000 companies that are in here. ROIC, return on invested capital, standard Bloomberg field. And I'll do it as the latest filing, which is last year. Boom, done. Then I'll do weighted average cost of capital, which is my WACC. So, and this is why market cap weighted average is important, because I now have the average for the oil and gas industry globally. So for average oil and gas company globally, last year, ROIC, negative 0.57%. Is that good? No, it's really bad. WACC for the industry, 9.17. I'm borrowing from investors, billions of dollars at 9%. I'm putting it to work, and I basically make negative 0.6%. All right, they have about a negative 10-point spread, and they're destroying a lot of value right now. That's the problem and challenge with the oil and gas industry. This is not currently an attractive industry. Now, it doesn't mean in the future things couldn't change, and the catalyst would be oil prices, but nonetheless, this is the current situation for 2015. Questions about that? All right, second question. Does Exxon have competitive advantage? Yes or no, and why? Because this is homework 4, by the way. These are the questions you're going to get on homework 4. Does Exxon have competitive advantage? Yes or no, and why? Yeah.
I would say from respect to the economies, it's going to be the size of the competition.
Okay, I want to look at it in terms of the financial definition we gave earlier. So thinking in context of the financial definition, yeah.
It has a higher than average ROIC and a lower than average weighted average cost of capital. So that's probably yes, by your definition, they're better than the average.
Correct. By the definition we're using in this class, Exxon has competitive advantage. Right? So that's the point. Is Exxon creating value? We do know Exxon's destroying value. But you can destroy value but still have competitive advantage. You just destroy less than your peers because you're better for reasons that he just defined at what you do, but they still can't escape $40 oil. So that's the point, is that competitive advantage means you're doing better than your peers. Even if you're destroying value, you can have competitive advantage, you just destroy less. And that's the point, is that the industry kind of overwhelms the company. And I can bet on Exxon, but what am I really betting on Exxon when I bought them for Stocktrek? I'm betting on the industry, I'm not betting on the company. Now, why did I pick Exxon within the industry? Because I actually think they're really good at what they do, and if the industry starts performing better, I think Exxon will do even better, and that's the very high-level bet I made in my Stocktrek portfolio. But to be honest with you, whether Exxon does well or not, it's going to be a lot to do with what happens to the price of oil over the next 60 days. So, back to this. This is what I mean by industry-level performance. Market cap weighted average is critical to put on your screen. Again, settings, global settings, check market cap weighted average in every one of your terminals. It's a by terminal number. Then, let's switch industries. And oh, by the way, what you're going to learn how to do is save this as a template. So I will call this 443 spread. I'll save it. Now, I've done this in previous classes, so it's going to ask me to overwrite it, but it will basically put it right here on the menu. So that way, if I go to any other company and I click on that, it'll automatically have this screen here. I don't have to keep adding it over and over and over again. So, give me another industry. Pharmacy? Okay, so let's look at CVS. Just a quick example. So here's CVS Health. here is RV. And here are the pharmacy benefit management companies. So again, here's what I mean. I go to custom, I click on 443 spread, and there it is. Save template. Okay, so pharmacy benefit management, PBM. Is this an attractive industry? Yes or no? Yes. This industry last year is about a 10.57% ROIC against a cost of capital of 7%. Does CVS Health demonstrate competitive advantage? No, they don't. All right, so that's the point. They're in a great industry, they're a great company, but they're not really outperforming the industry. So from a competitive advantage standpoint, it's not translating into above average returns. Everybody see that? That's the way I want you to start thinking about this. Questions? Yes.
So if you're using the market cap weighted average,
Yep.
I mean, obviously, since that's a mean, though, isn't that just susceptible to being like skewed by outliers? Because there's that one company next to Ascendant Solutions that has like 23.80
Well, here you go.
return on investment on invested capital. So
Walmart is the market.
right.
I mean, if you look at Walmart and its peers, Walmart's market cap is $220 billion. The next closest is Costco at 66. So the ROIC is skewed
Right, so
towards
it's
market's
susceptible to being
performance.
skewed to that.
It will
So-
be.
Right. So then, in certain industries, wouldn't that be less of a weaker indicator in
Well,
terms of competitive
If you
advantage?
just looked at its total dollars in demand, this is where the total dollars in demand for the industry average tends to be. So I'm not saying you couldn't make some arguments, but for our
Right,
first
okay.
pass, I still want to know where that average is. Even if Walmart's the average, then how are you doing against Walmart? Right. So in this case, let's go back. So Walmart's probably going to be close to average because they are the industry. So is anybody really doing well in this industry? Does Costco have competitive advantage over Walmart?
No.
What is Walmart's spread? 7.17. In fact, this will be one thing you'll learn to do on Wednesday. You can create a custom field that says spread, take the two, subtract, boom, there it is. But we have to do the math manually. What is Costco? 1423 minus 7.87. So do they actually have a positive spread compared to Walmart? No. So that's the point. They don't really have competitive advantage. Target does. Costco doesn't. Not at this level of performance. Now, it doesn't mean Costco's not creating value. Matter of fact, Costco's growing a lot faster than Target, so that might be attractive to me. But nonetheless, this is the first screen, first pass, first cut of what I want you to start thinking about for industries. In fact, here's another one, Chipotle. Eat a burrito, end up in the hospital. Fast casual. How's the fast casual business doing? Yeah, this is the best of the bunch. It's the companies like Chipotle and Panera and Shake Shack and Papa John's and Wendy's and Yum and McDonald's. This industry is doing really, really well. Okay? Is Chipotle doing well right now? No, not compared to their peers. What was ironic is a year ago, Chipotle was doing much better than their peers in ROIC. That was the impact of everybody staying away after the health scare. So the whole point of Chipotle is, are they going to recover the performance back after their health scare? And are people going to go back, drive them back to sales growth and drive them back to profitability? Because right now, they took a dip last year, and you can clearly see that in their performance, particularly if you go back 2 years at their historical ROICs. So nonetheless, this is an attractive industry. Fast casual is a very good industry. Now, will it be this good in 5 years? Is a separate question we'd have to start thinking about, but nonetheless, a question that we need to address. Questions about any of this? All right. So this is one of the core screens you will do for industry I and company C. But you're going to be a little bit more advanced because what I showed you is done in the real world, but it's naive. And I'm going to teach you how to go beyond naive. Because even what Bloomberg trains you on in advanced Bloomberg training on Wednesday, I consider to be naive. And the data that Wall Street uses, I consider to be naive. And when you go work for Goldman Sachs, what you're going to show companies is what I consider to be naive. And I'm going to teach you advanced. And that's what McKinsey does, and that's why I think McKinsey makes the big bucks. So here's the point, real world example. Let's look at a company called Molson Coors, ticker symbol TAP. Okay. And if I look at 5-year total shareholder return, Molson Coors has actually been doing relatively well, right? But I want you to understand this because that's not what the data says. And this is where it takes a sophisticated analyst to understand what's going on in Molson Coors versus what I would call a naive analyst understanding Molson Coors. And this is where the data will get you awry. So let's go back. RV. So Molson Coors, according to the Bloomberg peers, bunch of beer and beverage companies. So companies like Monster, as in addition to like a Brown-Forman or a Boston Beer Company. Okay, but basically, if you don't know Molson Coors, I mean they're Coors, Coors Light, Molson Golden, basically the cheaper beers, right, in the marketplace today. So let's go over here to custom, and let's do our spread template. So this is the spread of Molson Coors today. 2015 cost of capital 6.65%, ROIC 4.32% in an industry that has an 11.35% ROIC. Is this an attractive industry? Beverages and beer. Yes. It's 11.3% against a cost of capital of 6.74. This is an attractive industry. Does Molson Coors have competitive advantage? No, they're actually one of the worst performing beer companies in the world in a golden age of alcohol. So here's the thing. 3 years ago, I was invited to the Molson Coors Leadership Forum, top 150 leaders, the Westin Hotel, February 2013, on the beach, overlooking the beach, during spring break. So just so you know, sometimes when I leave the class, I get to go to these forums. And what was nice about the Molson Coors Forum is just like there were a bunch of 21-year-olds drunk on the beach, partying, having a good time, these were just a bunch of drunk 50-year-olds having fun, having a good time, because the Molson Coors Leadership Annual Retreat at the beach is just like a party. They had rock bands, they had music, they had free alcohol everywhere. It was a wonderful party. But the point is they have a Bloomberg terminal in Golden, Colorado, and they knew that they were the worst performing beer company in the world during that 5-year period of time. That they actually had a negative total return to shareholders at the time, and basically their spread was negative and still is negative compared to their peers. So I was brought in to basically say to their leadership, you suck, right? So, and then, oh, by the way, go back to your party. And so on a stage, they put me on in a ballroom at the Westin. Everybody's in a bunch of round tables, you know, with drinks in their hands. And I'm sitting up there on the stage, Bloomberg screen in front of me, data for all to see. So I'm not just saying it, and I'm actually giving them data why. I'm explaining them the concept of spread, just as you understand the concept of spread. So let's talk about growth. Do you want to grow when your business is doing this? I mean, if you're borrowing from the market at 6.6 and you're making 4, should you do more of that? No, growth is actually bad for you. Growth is value destructive. So fix the business, slow down the growth, and then we'll talk about improving value. All right? So the leadership's ready to swing the corporate axe. Let's go whack a few of the people in the room away, cut the costs, because we got to fix our business model before we grow our performance. Everybody understand that message? And how I deliver this message using this data. So this is the actual message I did. Sitting to my left was the Molson family. Sitting to the right was the Coors family. Sitting in the middle was the C-suite of Molson Coors and all the leaders in the room, top 150. My message to them was this. You guys are doing a phenomenal job. Keep up the good work. Accelerate the growth even faster, and you will create more value. That was my message. You know how quiet in this room was? It was just as quiet in that ballroom. You could have heard a pin drop. Because people were probably thinking, what the hell? This isn't what I see on here. And the problem is the definition of ROIC that is used in the real world today. Here's what I mean. If you right-click on any field within Bloomberg, you can do Show Definition, which will show you how it was calculated. And in this case, ROIC is the profit, the NOPAT, divided by the average invested capital. So let me close this, and let me add in a column for total invested capital, which is again a standard Bloomberg field that calculates standard ROIC. And again, I right-click on that, Show Definition. And the definition that is used in the real world that you learn in every business school class is debt and equity. That's invested capital. So return on invested capital is the return on the debt and equity. And so here's the point. Balance sheet's got to balance. So return on the debt equity equals basically the assets of the business. And here's the idea. If I have more assets, I need more debt and equity. And if I give you more debt and equity, I got to get a return on all the money I gave you. That's the way that the world looks at companies. But here's the point. Built into those assets are what I call operating assets and non-operating assets. Operating assets in the case of Molson Coors are the actual plant, facilities, inventory, receivables that they actually use to make beer. Non-operating assets are things that they own that have nothing to do with making beer. So I'm talking to the leadership of Molson Coors, which are the people that actually make beer, and what I'm telling them is the return on all of Molson Coors, which includes the non-operating assets as well as the operating assets. Well, for most companies, they have two types of non-operating assets. One, they got a bunch of cash sitting in a checking account somewhere around the world that they don't do anything with to avoid taxes. Two, they have a bunch of joint ventures. Molson Coors fits into the category of having a big joint venture with a company called SAB Miller at the time. And they'd put hundreds of millions of dollars into this joint venture. But here's the point. They don't run and manage the joint venture. They're the minority partner in this joint venture. So they put money into it, but the people in this room have nothing to do with the joint venture. They just make Coors Light. So here's the point. I'm not talking to the people in the joint venture. I'm talking to the people that make Coors Light. And the problem is that data mixes the two together. And with the mixed message, the leadership team of this company is ready to start swinging the axe and getting rid of people that are literally in that room are going to be gone and are going to be laid off and their plants are going to be shut down because the performance of their business says that they're only earning 4% in a world that's making 11%, and they're under tremendous pressure from the analysts. But here's the point. The operating ROIC, which is the return of the business, may not be 4%. So this is what you're going to hate me for next week, but this is the advantage of the textbook that you're using, is we're going to break out the operating ROIC and the non-operating ROIC, which will lead to the average ROIC, which the rest of the world looks like. So, operating ROIC, this is a custom field that you will have to create in Bloomberg. It doesn't exist in your terminals today. So this is why you need to pay attention on Wednesday, because Bloomberg is going to teach you how to create custom fields. And I gave them the definition for operating ROIC that we're going to use in this class to teach you how to do it, but they're not going to do the actual fields, but they're going to show you the process. But here's the point. What is the operating ROIC of Molson Coors beer business? 14%. Do I want to slow that down? No, that's my point. You get a beer business, the people I'm talking to that are doing a really good job. So if I think about Molson Coors, they're ready to slash the beer business to improve the performance. When the reality is the problem's not the beer business, the problem's the joint venture. Fix the joint venture and let the beer business step on the gas. This is the difference between a naive analyst and a sophisticated analyst. And by the end of the semester, you're going to start to understand how to be different. Because the rest of the world focuses on the easy to have calculated standard screening ROIC in Bloomberg. And I'm not saying that that's not the performance of the company. But if Molson Coors over the last 3 years focused on improving the beer business and fixing the joint venture, do you think that their stock price would have gotten better? Yes. So that's the point. If I keep making 14% and my ROIC as a company was 2, then it's 3, then it's 4, then it's 5, and it actually improves over time because I'm actually doing the right things for the right reasons. And so this is why we're going to start disaggregating the data in this class into operating and non-operating, which unfortunately the accountants don't do that, and people like Bloomberg don't do that. So we have to do it manually. Now the nice thing is once we do it manually and insert it into Bloomberg, it'll automate it for us, but nonetheless it's not standard fields within Bloomberg. So this is what's unique about the next 2 weeks of doing this class differently. But unfortunately, it is a pain in the butt to put things into this process because accounts don't think this way. And we deal with accounting data where they've just jumbled it all together. And we got to then disaggregate it into these sections. But that's what, when you hate this assignment the next couple weeks, that's what this assignment's going to be able to get you to do. It'll get you far more insight. And this is what McKinsey does, by the way. And this is why McKinsey's in 1,000 boardrooms. Because Goldman will come in there, JP Morgan will come in there, and they'll come in with the standard ROICs. And McKinsey will come in with this additional insight. And it makes sense to the senior leaders. And that's why they'll get the ear of the board. Okay? And so this is just their approach. But nonetheless, I think it's a very valuable approach. Questions? Comments? Okay. So, time check. All right. So here's the next thing you're going to do. Once you do all this, EQS stands for equity screening. Is one of the other features of the Bloomberg tool is that it allows you to search the 870,765 companies in the database and to screen on any number of criteria, including custom fields that we create. So it's got domestic and international companies, but this is also going to be part of homework 4. So let's say I want to look at the S&P 500. So I type in SPX. And right now, there's actually 505 companies in the S&P 500 index. All right, and that's just the nature of Standard & Poor's literally moves companies out, moves companies in, and as of today, there's 5 in that haven't been moved out that will be moved out over time. But there's actually 505 companies in the index today. Anyways, back to this. So for the S&P 500, I can then do some screening criteria. So what I just showed you is something called operating ROIC. And for operating ROIC, which is what I really want to invest in, that's a custom field that you don't have, then I can say, show me operating ROIC greater than 20%. Here are the companies last year that in the S&P 500 index that had an operating ROIC greater than 20%. There's 128 of them. Then let's look at revenue growth greater than 20%. So there are 12 companies in the S&P 500 index, which I would call 2020 companies. They're growing at 20% a year, and they have 20% operating ROIC. That's these companies. You know who's on this list? Google, Alphabet. You know why I put them in my Stocktrek portfolio? Because they're on the 2020 list. That's the other reason why I put Google in my Stocktrek portfolio. Is I did this screen in the 11 o'clock section, and I saw that these are the companies that are growing at 20%, that have a 20% ROIC, and I thought about who's going to do well in the future. And Google keeps popping up as somebody I think that's going to continue this for a little while, and I think they're going to win in this marketplace. Now again, past performance does not equal the future. We're going to deal much more with the future in this class, but nonetheless, I can start doing some screens for things. And this is part of what your homework 4 is going to be. So you're going to have to create custom fields. You're going to put the custom fields in the database. You're going to have to do the RV screen to get the custom data in the industry. And then you're going to have to use the custom fields to screen criteria to meet companies that meet that criteria. That's going to be called homework 4. And as I said, Bloomberg is going to spend a lot of time on Wednesday teaching you how to do the mechanics of what I just showed you. Because they know that this is your homework 4 assignment. And I talked to them this morning about it before they're coming on Wednesday. So long story short, this is valuable. What also could be valuable, and again, I could do my own screens, but I could also say, and you can see that they have some popular screens here, and I can save the screens. So I can save this if I want to save this as a custom defined screen. And when I come here to formulas, I can also create my own custom formulas right here in the screening tool right before I screen for them if I wanted to. So let's go back. EQS, overwrite the screen. So let's look at country of domicile, North America, US. So in the Bloomberg database of the 871,000 companies, there are 12,420 publicly traded companies that are in the US. Okay, so that's in the database. And then what I could do is I could add a criteria that says revenue, just total revenue greater than $1 billion. So if I look at the US, there are 1,389 companies in the US that have revenue greater than $1 billion. Okay? Now, let's say that I'm worried about exposure to Europe. Okay? So one of the things I could do, and you can see this here, is I can look at revenue by product segment revenue percent in an industry, right? And what I could say is the revenue for the latest quarter in industrials, in aerospace and defense, in whatever, and I can get very specific. But the point is, I can actually do, tell me who has exposure to Europe. Tell me who has exposure to Asia as a percentage of their sales. So if I'm worried about a currency exchange, I can see which companies actually have the biggest portion of their revenue tied to a particular region. And that's where I go back to Stocktrek. So this is what I mean by if you really want to win Stocktrek, you can go in and be a little bit more sophisticated as a team because you can use the equity screening tool that if you really thought currencies were going to change because of what the Federal Reserve is doing, then you can look at who's exposed to those currencies as a percentage of their revenue, and then you can make a bet on that company. Okay? Or you could just make a bet on a company. So you don't have to do this. But this is, again, just taking advantage of the tool that you guys have access to this semester, because these are what the professionals use that work for the funds to do their screens, and you can do some pretty sophisticated screening of the data in the database. So again, I'm going to let Bloomberg go through this with you on Wednesday, but you will have to use the equity screening tool as part of your next homework assignment. All right? So let's go back. Lockheed Martin, U.S. equity. Here's something interesting, RV, custom, spread. Forgot to add the operating ROIC, custom field. So ROIC is the Bloomberg standard definition, return on debt and equity. ROIC is the operating return. If you take the operating return, the non-operating return, you get the average ROIC that the market looks at. So notice anything interesting about Lockheed Martin? What do you notice?
Average is way higher than its operating.
Yeah. So that means the non-operating is the opposite of Molson Coors. The Lockheed Martin's doing really well in the non-operating stuff. Okay? So if they just sell more planes, they actually look much more like the rest of the industry. So it's obviously for them, so again, one thing you got to be careful of is that, oh, this 29% ROIC looks great, but as their volume goes up, the operating and non-operating go up at different rates. And so therefore, if the non-operating doesn't go up with the operating, then their ROIC could actually go down versus 29% on a go-forward basis. Questions? Yes?
Can you get into how the operating ROIC is calculated?
Yeah. Well, this is what I'm saying is that you're in the book, your readings for next week is to calculate, to take income statements and balance sheets and to rearrange them into operating and non-operating. And so that's what the rearranged balance sheet is going to be called TFI. And the whole point of the rearranged balance sheet, operating assets, non-operating assets. And then the rearranged income statement is going to be called TII. Operating revenues and operating profits, non-operating revenues, non-operating profits. And then CFI, which is cash flows. Operating cash flows, non-operating cash flows. Free cash flows, operating cash flows. But we have non-operating cash flows too. Business is the sum of the two, enterprise value. So we're going to put the statements into this format so that we can quickly do this analysis. And while you're learning how to do that, simultaneously next Monday's homework assignment in particular, is going to be to come in here to operating ROIC, and you can see the definition here. Well, actually, you can't see the definition here. But there is a definition for operating ROIC. So in order to do this, you're going to have to calculate operating working capital, which means you're going to have to calculate operating cash and excess cash, which are all new Bloomberg fields. And then you're going to have to calculate operating long-term assets. And you're going to sum these to get operating invested capital. And then you're going to have to get operating NOPLAT. And then you're going to calculate operating ROIC. So that's your next homework assignment, is using the fields that I give you, go to Bloomberg and create so that you actually have this stored in your Bloomberg terminal that you'll use as we'll go through these screens throughout the semester. So that's part of what you're going to learn how to do this week. So this is a preview of what we go with the analysis, though, because that's the nice thing about this class, is that we don't live in the world of Harvard Business School here. Like, they pick cases which are at exact point in time, which prove a point exactly that a professor had actually figured out. We deal with the messy real world, which is we got to figure out why is Exxon really trading at what it is and what's going on with this company. And we're giving you the exact same data that the pros are getting. And so to me, this is interesting. But it does mean that we have to kind of get you guys up to speed on using this tool, the certification. It will help you in your careers, seriously, when you do the interview process and you interview for Wall Street. This certification will really help you. It's a leg up on everybody else. And the fact that Bloomberg is willing to spend an entire day of their time to do advanced training for you guys is also huge, because the people that are training are the people that train the new hired analysts at Bloomberg on how to use their tool. So you're actually getting training from people who really know how to use the tool. So take advantage of this in terms of Wednesday's class. It's important you do, because you won't be able to complete your next homework assignment if you don't. So there is a little bit of a stick to go along with that carrot, but nonetheless, that's what sets up the next few classes. So here's how it's going to work. Wednesday, apologize, I have a previous commitment. I will not be here. I'll be in Miami and Sao Paulo on Wednesday. So unfortunately, I have to go to the Zika capital of the world in 2 different countries. Like, literally, I was looking at Miami Beach. There's a hot zone, and the hotel I'm at is literally in the middle of the hot zone. So hopefully I dodge the mosquitoes while I'm there and don't come back all Zika-fied. But in any event, so I will not be here on Wednesday. The TAs will be here with Bloomberg. They'll be shepherding them through the classes. We're hopefully going to be recording one of the sections. I'm going to ask IT to come in and record it. But sometimes the recordings have trouble with those cameras in the back of the room. So I can't guarantee it's going to be recorded, but we're going to try. So here's the point. Wednesday is Bloomberg. Monday, I'm going to call it a Bloomberg lab. So here's the point. To do homework 4 will be made available at the end of Wednesday after Bloomberg finishes, so about 5 p.m. And so what you'll then do is you'll have Monday's class to complete homework 4, because you will have to use the terminals to create all these custom fields. And as you can see, there's only 25 terminals in this room for 40 students. And there's just not enough terminals to do it during class time. So just like your certification, Monday is a lab day. I'm calling it a lab day. But Monday's your time in class or outside of class to do the custom assignment. In addition, the lecture that I was going to do on Monday is going to be a video, an hour-long YouTube video. So before the following Wednesday's class, a week from this Wednesday, you need to watch the video on economic statement conversion. You need to read the chapters in economic statement conversion, and you need to do the Bloomberg lab assignment to create the fields for the economic statements in the terminal, and to be able to learn how to do the equity screening based on those fields. So you've got a lot to do between now and next Wednesday. Next Wednesday, a week from this Wednesday, we'll then pick up with the lecture at that point, and we'll get into more of the economic statement conversion messy stuff. But I will also tell you, please watch that video before showing up in class, because the economic statement conversions are just something you're just not familiar with. And number one, if you don't remember your accounting, it's coming back. So as you have teams created, I assume that randomly there's some finance and accounting majors or some accounting majors in there. Make those people your friends this semester, because the accounting people can help you as you understand how to convert the statements, because we're going to start with accounting statements when we put them into this economic framework. But they're still going to struggle because it's not statements they're used to converting. So what I'm telling you is, if you don't read the chapters and you don't watch the video, when you come back to class, you're going to be completely lost as to what we're doing. So the good news is you got some time. The bad news is don't not use the time. So make sure you do the assignments And then we'll have a productive class because that's going to be core to what your midterm exam is about. Questions, comments, concerns, crippling fears? Yes, sir.
About the Bloomberg certification, when we like finish a section, all we get is like a check mark.
Oh yeah, I might not have covered this at the beginning of your class.
Okay.
So when I was on the phone with Bloomberg today, the Bloomberg market concepts, they're continuing to change it. And unfortunately, we're in the middle of one of their changes. So what they told me is when you take the certification and the multiple choice questions are now dispersed throughout the module, it used to be at the end, they moved them through into embedded. You got to get 70% of those right arbitrarily to pass. However, they only show you the score the first time you took it. So even if you go back and retake it, they don't show you a change in score. They only show you the score from the first time you took it. Now they're tracking the multiple scores, but they don't show you the change in scores. So I said, well, how do I let people know how they did? So what they said is they can run a custom report, which they're going to do after Wednesday, to tell me what your scores were on each part of the certification. So what I'll do is I'll basically say for the people that had passed, you're done. For the people that haven't passed, I will notify you and say, here's where you're deficient, and then you'll get one more attempt to actually improve your score. So here's the point. Right now in the certification, it'll give you a check regardless of your score. So literally, if you just went through really quickly, got everything wrong, they would still check that you have been finished, and they would give you the certificate. It's not what they want to do, but that's kind of the process of where the code is as they're slowly moving it to the new standard. But they even told me they're a couple months away before they actually start enforcing the certification. So there's a little bit of a loophole in there right now, but unfortunately for you, I am closing the loophole by saying it has to be 70%, and they're going to give me a report on whether you did 70%. So nonetheless, I can't tell you whether if you got like 68 and you took it again, I can't tell you whether you did better or worse. Bloomberg is like, well, if they studied really hard, they probably did better. That's actually what they told me. And I was like, I don't think that that's a standard that I could use. So we're going to go with the reporting standard. Well, they'll tell me the percentage, but I won't be able to tell you what the percentage is. You'll only see the percentage for your first attempt, and it won't change in the software. Saw another hand there? Questions? Yes? Yeah, whatever the best grade is, best of 2 is what we need. So if you think you did better the second time, then you're good. And you won't have to take it again. Okay? All right. So again, Wednesday, Bloomberg Day. Everybody have a good day in the interim. Finish your certification if you haven't. Because regardless, you should know what's going on before you show up on Wednesday.
So I finished on my series.
Have a good afternoon.